All right, everyone, welcome to the next meeting of Advanced Financial Accounting 1. So we're going to continue material from last time meeting because this is still in focusing on chapter 2, right? So now we're moving to the comparison of cost and equity method. Okay, so as you know that I think before we've been mentioned that the cost method is actually consistent with the historical cost passive, right? So, but it has been, uh, you know, there is information stated that the cost method is actually, closely related to the traditional accounting, right? So here is the summary comparison of the cost and equity method. So at this part, there is an item and how to record it. Okay, so when there is a recorded amount at investment at the date of acquisition, so the cost method will using the original cost, and also going to comply with the equity method in original cost, and the carrying amount of investment subsequent to acquisition. So this is the one that you have been highlight, right? So subsequent berarti setelah ya. So at the date berarti pada tanggal. So for you, for special for international student guys, I think I'm trying to explain it then fully in English, but I also sometimes want to add, some more explanation in bahasa just to make your friends are comfortable and more understand about the concept. Okay. Yeah. Also, in original cost is applied by using the cost method. In equity method, as original cost increased by investor share of investing income. So the original cost will be increased or decreased the investor income and decrease by investor share of investors dividend. Alright, so jadi ini biaya perolehan awalnya itu ditambah atau dikurangi bagian investor atas laba atau mungkin rugi investinya gitu ya. Atau misalnya decrease, jadi like as we've been discussed before, what aspect that can affect the investors income, right? So and also there is investor share in there. So what sort of activities that been affected by them, and then related to the income recognition by investor here, right? So by using the cost method, part investor share of invested dividend declared from earnings since acquisition. Jadi bagian investor atas dividen investinya itu diumumkan sejak tanggal akuisisinya gitu ya. And begitu juga dengan equity method since acquisition. And the next one is related to invested dividend from earning since acquisition by investors. So this will be recorded as an income by using the cost method, and will reduce the investment in equity method. With regard to invested dividends in excess of earnings since acquisition by investor. So before it's invested dividend from earnings since acquisition, but this one is excess the earning, right? So the cost method, in the cost method, will be reduce the investment, or there is a reduction of investment. Okay. And then so this is what the comparison, everyone. It means that equity method sometimes has been criticized because the asset valuation from the historical cost, but will be sometimes moved to the market value approach, right? Okay, but however, yeah, even though there is a criticism by using the equity method for the substitution of the consolidation, but this has been viewed as the one-line consolidation, right? So it means that the amount or the detail that has been reported under equity method, it's kind of the different. I mean, it's a differ from with the consolidation. So this one, investor will report the same equity method income from following two investee, right? So the investee one had the amount of 50,000 sales, and there is an income and loss in here. There is a gain on sale. So the investment in another company is reported under the equity method as a single amount in the balance sheet itself. Okay. Right. So next one, the focus is how we can prepare the journal entries or by using the fair value option. So this is, yeah, okay. All right, so this is ASC. Kalau in Indonesia, we call it, there is PSAK that also been focused on this one, right? Okay. So let's have a look at this one. Companies to measure many financial assets and liabilities at fair value. So there is certain situations stated at that. Okay. And then, okay. Now, rather than using cost or equity method to report unconsolidated investment, investor may report this investment at the fair value. So under the fair value here, the investor will remeasure the investment to their fair value, right? And then they probably recognize income after that. To illustrate using the fair value method here, for example, as Ajax Corporation purchased 40% of Berkeley Companies common stock on January 1 for $200,000. Ajax prepared financial statement at the end of each calendar quarter on March 1. Ajax received a cash dividend, $1,500 from Berkeley. On March 31, Ajax determined the fair value of investment to be $207,000. So Ajax record the entries, right? So for the investment in Berkeley, they invest around $200,000, right? So this is the recording that has been made by Ajax Corporation. Investment in Berkeley, 200, in cash, 200. And then there is a dividend income from Berkeley, right? So Berkeley have a cash dividend around 1,500. So remember, this one will be giving. We were recorded as a cash on the Ajax side, right? So having a dividend income from their investment around 1,500. And the next is there is a fair value increased of Berkeley stock, so it will be increased the value of investment of Ajax in Berkeley. Okay, so remember this is an Ajax corporation. Okay, so there is unrealized gain on Berkeley stock around 7,000 here. And then now we move to the overview of the consolidation process. So this is a basic consolidation. So it's just kind of, yeah, the formula, and also the more explanation will be discussed after this. This will be discuss about the consolidated financial statement, all right? So the procedure.
It's 10 hours.
So the focus, so the separate financial statement of the company will be involved as the starting point each time consolidated statement are prepared. Okay, and then the separate statement, they add together and there is some adjustment, and then they generate consolidated financial statement. Okay. And yeah, while the company is having a consolidation, it means that there is a sales, a receivable, payable to one another that happen, right? So the consolidation entirety, it means that entirety, the one that has been, in that area, must report this section only with party outside. So this information as you should be highlight, guys, because following explanation will be just related to the consolidation. So if there is, so it means that the consolidation entirety as a whole must report transaction only with parties outside, right? So this is required part of consolidation process to make sure that the consolidated financial statement presented, if it's stated as a single enterprises. Okay. And then this is a consolidation procedure for wholly owned subsidiaries that are created and purchased at the book value. Okay. So this is a preliminary information stated that preparing consolidated financial statement with the book of individual company that are to be consolidated, because the consolidated entity has no books, all right? So the all amount in consolidated financial statement, it's originated on the book of the parent or a subsidiary in the consolidation worksheet. All right. So you've been understand what is a subsidiary, what is the parent, right? So parent is actually control the financial, they hold the controlling financial interest, right? So the parent, sometimes they doesn't need to hold all the corporate subsidiary common stock, but at least majority ownership. So we've been also discussed before, right? Talking about the ownership, right? So it would be required, there is a presentation that's stated about the ownership in the consolidated financial statement. Okay. But corporate subsidiaries are wholly owned. Yeah, most of the case, the subsidiary required by the parents, right? Because most of subsidiary wholly owned. So we going to discuss in here about the consolidation procedure for wholly owned subsidiary, right? And then we're going to start from how the subsidiary is created, right? And then after that, for any amount that is exactly equal to the book value, and assumption and simplify that the consolidation, because there is no differential. So there is no differential here, right? So we start with the basic consolidation procedure will be applied to preparation of consolidated balance sheet. And then after that, we also this week also going to focus on the use of simply consolidation worksheet. Right. This one talking about the consolidation worksheet. So this is a mechanism or for combine the account of the separate company involved in consolidation. So for example, there is a company A and company B have their own worksheet, right? So we need to do the consolidation worksheet to combine it together and adjust the balances to them. So make it in one single, right? So there, when we might to consolidation financial statement, so the account balance that taken from separate book of the parent subsidiary will be put and placed in consolidation worksheet, right? So there is a format, but companies usually have the different worksheet format, right? So usually using the 3-part worksheet consisting 1 part of each of 3 financial statement. There is income statement, statement of earning, and balance sheet. But recently, the written earning has been dropped by many companies, right? So because there is a statement of the change stockholders' equity, but it still be found in written earning statement. Right, so this is the format that using for 3-part consolidation worksheet, right? So you can see here, so this is a basic format, right? This talking about the consolidation entry here. All right, so the mapped in the column that we call it consolidation entries that need to adjust this one and eliminate. So this one would be adjust and eliminate balances that result from the amount when the company have the transaction, or probably only there is a transaction becoming single company. This is the one that we summing all amount, right? So after we make the consolidation here, okay. So this is the illustration. Income, revenue, expenses, statement of earning, written earning, and balance sheet in here. So this is a format for consolidation worksheet. All right. Okay, and then after that, so this is just a technical. After you edit, then you make the bottom line, the total there, and we can see that parent net income, subsidiary net income, right? So the total of debit credit adjustment, and yeah, but the format is actually the same with the written earnings statement, right? Okay, so you can just try to read this one, then we move to the nature of consolidation entry. I'm just going to make it really quick in here because consolidation entry is actually about the consolidation worksheet that need to adjust the total of individual account balances, right? So the consolidation entries appear only in the consolidation worksheet and do not affect the book of the separate company. And the worksheet is called elimination entry. All right, so companies that are to be consolidated record the transaction during the period without regard to consolidation entirety, right? So the transaction with the related company sometimes recorded with the unrelated parties. Although there is an intercompany transaction, will be recorded in a separate account, or the other record may be, facilitate elimination. So we're going to see the example after this, all right? So there is a consolidation entries we use to increase and decrease the combined totals of individual account. Okay, okay. So this is just an example. Parent company sell land to subsidiary for 100,000 above the original cost to the parent. So the wash entry needed to reduce the basis of land by 500,000 each time consolidated statement prepare, as long as the affiliate company hold the land, right? So consolidation entries are not met on the book of any company. They do not carry over from period to period. So this is the one that have been highlight. Gotta put in pink. Okay. And then this is a consolidated balance sheet with the wholly owned subsidiaries. So let's have a look at the example here. It's a peerless product corporation, purchase all the common stock of the special food. So it means that is acquiring 100% ownership, right? All special ounces of common stock and amount equal to the fair value. On the date of combination, the fair value of special food individual asset and liabilities are equal to their book value. So because Fearless acquired all special food common stock, and because special food has only the one class of stock outstanding, so the total book value of the share acquired equal to the stockholders' equity of special food. So yeah, so the value is outstanding here. The fair value consideration 300,000, and the book value itself, it's common stock 200, and then patent earning is 100,000. So there is no difference, right? No differential here between fair value and also the book value. This is the balance sheet of the PLS and special fruit. So P for the parent, S for the subsidiary. Okay. And then PLS will record there is a stock acquisition, right, for the special fruit around 300,000, right? So okay. Oh, sorry, this one. Yes, and yeah, so this is a basic consolidation entry before I think I'm going. Okay, this is Payless balance sheet has changed to reflect 300, and note that 300 cash was paid to former stockholders to special food, right? So the cash is no longer in consolidated entirety, but it's been reflect 300,000 investment. The basic consolidation entry remove the investment in special food stock account. Okay, but this one example, Payless investment is exactly right equal to the book value of the special food. So there is no goodwill recorded, right? Okay. All assets and liabilities are simply combined from special food, financial statement, and their current book value. Okay. And this is just about coverage of the coverage chapter. Okay. The balance sheet. And yeah, so this is the illustration here because the book value is the same with the fair value. So there is no goodwill here. So total investment in 300, common stock 200, and return earning 100. So this is for talking or related to the book value calculation. So the consolidation entry simply credit the investment in special food. Right. So it would be moved to the credit. Right. So this one drop out later into the assigned number from the value. Okay. Acquisition price of 300. So in response to that, we have to eliminate the beginning balance here because the common stock, return earnings, so investment in special food will be moved to the credit side if 300,000. So this entry is met on consolidation worksheet, okay, everyone? So not on the book of the parents, not on the book of the subsidiary, and it's presented here a general journal for the instruction purposes. So investment account must be eliminated because from a single entity point of view, the company cannot hold an investment in itself, right? Okay, so that's why we call it one line consolidation. So if there is a consolidation happen, it means that the subsidiary individual asset and liabilities, it's combined with the parent, all right? Okay. So, and include both of the net asset of subsidiary here. So I'm just going to highlight and represented by the balance and investment account and also subsidiary individual asset and liability will double count the same with the set asset. So that's why the investment account is eliminated and not will be carried in the consolidated balance sheet. Okay. This one, the acquisition price of the PLS is equal to the fair value. So that will be reflect the normal situation in which acquisition price paid by a parent is actually equal with the fair value of the proportionate subsidiary itself. Okay. And this is actually the optional calculation of the precision consolidated entry. So there is an optional that provide a more correct consolidation. So when there is company want to acquire depreciable asset, so it will be record the asset with the zero balance, right, in accumulated depreciation. So when the company will be acquire all of the net asset in another company, the depreciable asset will be recorded without any existing accumulated depreciation, right? So the buyer will disregard the historical cost of the seller. So it also happened when the parent company acquired the stock of subsidiary. So the consolidated financial statement will be include the depreciable asset here, right? Without there is a pre-acquisition accumulated depreciation. But in the stock acquisition, the consolidation worksheet will begin with the book value. So eliminating the old accumulated depreciation of subsidiary as an acquisition debt, right? So it will be give the appearance that the depreciable asset that has been newly acquired. So special food here indicate that accumulated depreciation on the acquisition debt is around 300,000. So the following entry will be mapped to eliminate the acquisition debt of subsidiary accumulated depreciation. Okay, so it will be here, we delete it. And then this is the optional for the entry of the accumulated depreciation. Okay. Right, so this is talking about the consolidation worksheet 4. This is just, yeah, just want to explain that why this happened, a number happened in here. So the balance, like accounts, will be placed side by side so that they made it added together. All right. Right. So there is a 2-column level consolidation entry here. So it will be highlight the each consolidation entry with the this with the same color, so we can identify it, the individual consolidation entry. And after there is an appropriate consolidation entry, this may well be sum up. So like this, there is a product 50,000, so consolidated become 100, so this one become 125, and this one becomes 0 for investment, especially for the right. And then this one has been decreased right here. The building equipment has been deleted, right? Yeah, so it has been becoming 1.1, and there's so accumulated depreciation. So this one will reflect this. Okay. Right, so this is a consolidated balance sheet. So there is a consolidation happen also subsequent to acquisition, right? So before the procedure that used to prepare consolidated balance sheet as the acquisition debt, but sometimes more than consolidated balance sheet is needed to provide the comprehensive picture of the consolidated entirety activities, right, after the acquisition, right? So there is a basic financial statement, right, for a consolidated entity will be consist like balance sheet, income statement. Right? So this will be focusing on preparing income statement, written earning, and the other. So let's have a look at this one. The consolidated net income is parent income from its own operation, excluding any investment, right, from the consolidated subsidiary, plus the net income that got from each consolidated subsidiary, and it will be adjusted also. So look at this example. Bush Corporation will purchase all of the stock of Shelf Company at amount of the equal to their book value. Okay. And then look at this one. The Shelf report net income around 25,000, while Push report net income 125,000. So including equity method income from Shelf to 25,000. So the consolidated net income will be as follows. Push net income 125 and equity method income from Shelf is 25,000. And the Shelf net income is 25,000. So the consolidated one is 125,000. Right, so remember in equity method, so we mapped the income that created by the Shelf, right? So because the income that attribute is actually from the parent itself. Okay. So when the parent company properly apply the equity method, the consolidated net income is always equal to the parent equity method of the net income, right? So got the idea, right? So this is a consolidated retained earning. It's consolidated, will be appear in consolidated balance sheet, and it will be explained that the portion of consolidated enterprises that undistributed earning accrue to the parent company stakeholder. Right. So this is a computation here. We adding the parent's retained earning from its own operation first, and the parent proportionate share of the net income since the date of acquisition, and then adjusted with the write-off probably and goodwill impairment happen. So yeah. So if the parent accounts for subsidiaries using the equity method on its books, so the retained earning is completely eliminated when the subsidiary is consolidated. So because retained earning cannot be purchased, right? So the parent share of subsidiaries' incomes is already included in the parent equity method retained earning. So this is a simple example given. Push retained earning balance is 400,000 and shop is 250. During 20x1, shop report 25,000 of net income, all right? So declare 10,000 of dividend. Push report 100,000 separate operating earning plus 25,000 of the equity method income from 100% interest in shop. Push declare 30,000. Okay, so this is retained earning balance of the push and shop. It's 400,000 here, 250, and net income reduced in that part, and then dividends declare will reduce it. Okay. So the consolidated retained earning is computed by determining the parent's retained earning from its own operation, right? So the competition will be involved, removed from the parent retained earning around 20,000 of the subsidiary net income. Okay, so it could be. So after it, remove it, it will be leaving around 470,000 because it has been increased by the net income that earned by retained earning, right? So there is income that has been purchased by the subsidiary. So the parent's 100% share of subsidiary net income since the date of acquisition added to this number and will be restored around 495,000, right? And we also remember that the first year since the acquisition, the net income since the date of acquisition is just this year's income, right? So that's year's income. Okay, but how it's in this different year, so it will be discussed after this. So this is a 100% ownership, right? So the one before, I think it's, right. So I think this is just like the one that we did before, right? So, so this is the information that you can see on the of the date of combination. So the common stock 500, I think it's so to be for your information, everyone. So this book is actually related. I mean, like the information is related from the beginning. So just make sure that you really check it. Okay. No, to this part. So we are now in this page, right? Oh, we done it this one, guys. Oh, sorry. My bad. I kept this appendix. Yep. This one. Okay. No. So this is the selected information that has been got from PLS and Specialfit, right? So for first and 1 year. So now let's have a look at this one, initial year of ownership. So pillars will record the purchase of special fruit as follow: cash 300,000 and investment in special fruit 300,000, right? Then pillars record operating earnings of 140, excluding its income from investing in special fruit, and declare 60,000. Special fruit also have net income 50 and declare dividend 30. So in the parents' entries or the parent side of entries, so the special fruit have the net income, right? Around 50,000. So because it 100 acquire the ownership of the special fruit, so it will record investment in special fruit increase around 50,000, and an income from special fruit got around 50,000 also. Okay, so the cash have from the dividend declare, right? But it reflect and decrease the investment in special fruit. Okay. And this is the initial year of ownership. There is an adjustment that we need, right? So this is information that happened here. So the distinction between the journal entries recorded on the book of the individual companies and also the consolidation entry recorded only on the consolidation worksheet is kind of the important one, right? So the book entries will affect the balance on the book and the amount that will be carried in consolidated balance sheet. In this example, the account that must be eliminated because intercorporate ownership are the stockholders' equity account of the special fruit. So this one, so this is a book value portion, everyone. So original book value first is 300, right? Got common stock 200, written earning 100, and after that, there is an income that can increase the value of investment of parent company. All right, so this part, I think, let me just give it, I only take, no, this part. And it will be so increase the written earning, right? So because it has been recorded here. And then after that, there is a dividend that will be decreased the total of investment. So now the book value, the ending of book values become 320,000, coming from 200 common stock and 120 written earning. Okay. So once again, this is the initial investment. And now this is a net investment in special fruit. Now it's becoming 320, right? So under equity method, pillars will be recognized 100% share on the special fruit, right? This one. Okay, all right. So pillars, okay, so pillars equity method income from special fruit, this one here, must be eliminated to avoid double counting. Okay. Special fruit dividend paid to pillars also must be eliminated when there is a consolidated statement prepared. Okay, so this one should be also eliminated because the dividend is just an intercompany cash transfer, right? So, so for example, here parents and subsidiaries, so subsidiary have a dividend and they declare it and give it to the parent. So basically, it's just happened on the one entity, right? So for example, when it's not coming from the external one, it's not coming from the other people. I mean, it's not part of, actually it's not part of the income because it happened in the entity itself. So for example, if you got the money from your parent, I mean like between parent and children probably. So now the kids has been produced and having probably run a business, and then parent is actually the one that invest the money in the very beginning, right? So now the children company having grown up and then having net income also, I mean, is actually that coming from the parent, right? Okay, so that's why it has been should be eliminated. Okay, but if the situation coming from the external shareholders, so it's in different part. Okay. So this is a basic consolidation entry that will be remove equity method income from special food and also declare dividend from the special food. Okay, so dividend declared before is 30,000, right? So investment before is in debit 320, right? So now this is a basic consolidation entry that will be used for this one. Okay, right. So the book value calculation on the preface page, it will be help to facilitate preparation of the consolidation entry. So this is the basic information that needed. Okay. So what the basic consolidation entry? It will remove the special food equity account, the special food definitely clear, the peerless income from special food, the peerless investment in special food account, right? So this is the one that have been noted. Okay, and eliminate the beginning retained earning balance since income and dividend are eliminated separately. So the basic will be eliminated the balance. Okay. So this one, when there is a acquisition, net income happen, dividend declare, and after that got this amount. And then eliminate. Okay, so this one also 50, 15 eliminate. Okay, that one, the information that there is an elimination. And this is optional one, talking about accumulated depreciation. Okay. So now this one is the consolidation entry, everyone. So you can just make and check it from this one. Okay, there is an adjustment in income from special food. So we debit 50,000. So in consolidated, it becomes 0. And then what else after this? There is a return earning. So in the statement of return earning, there is 100,000, right? Yes, balance in the debit. So we make it in here. And after that, there is a dividend declare. Okay, this one or 30,000. So will be less. And after that, investment in special food also been eliminated. And then this one found in here. So this is a basic consolidation entry to make, and then you can put in here, right? Then also there is common stock, okay, 200,000. And this is the optional one, the consolidation entry, the one that we talked before, okay? Right, so that was the basic information. And okay, right, so we've got the idea, right? So this is also the amount related to this one. This is just the total, okay? The total of this one, and the net income 50,000, and this is the accumulated position is total here, right? So there is a written earning also before, right? With the, yes, with 30,000 written earning. Okay. All right, so this is just an additional information about the consolidated net income and written earning. This is the last number of income statement section, right? So this is the last proportion, right? So peerless net income, equity income got at this amount, and then this is the consolidated net income. Okay. All right. So you can, check it again and make sure that you understand this part, because this is the information that you're going to use for the later chapter and also understanding, right? So you have to be really understand about this part. Okay, so there is also the appendix. So if I think I suggest you to read more about this one also. Okay. All right, everyone. Thank you so much. So we'll cover this one, but once again, I told you guys, just please ask me a question. Okay, I want a question. I want you to ask me a question. Okay, so just don't hesitate to contact me or put the question in discussion forum. So I made it, but no one put the discussion on there. So sometimes I didn't create the discussion forum anymore. Right. Thank you so much, guys, for your attention. Thank you. Assalamualaikum warahmatullahi wabarakatuh.